So, Larry, at the very end of the week on Friday, we got the jobs numbers, a little bit better in some respects than what was expected. What do you make of them?
I don't think they were a big story. The employment number was better than people expected. The unemployment number was worse than people expected. I think what stood out for me was that labor force participation did not increase. And with 25 states phasing out unemployment insurance, with everything that was happening, this long-awaited return of those out of the labor force is materializing more slowly than I think many people expected, and that's a little bit ominous for the future of wage inflation. The headline figure, 0.3% growth in wage inflation, doesn't seem so bad, but given that the workers who are coming back are disproportionately low-wage workers, and that holds the number down, I think that's a bit more concern for inflation.
So that wasn't the big event some people thought it might be. Talk about the CBO report. The Congressional Budget Office came out with a report that talked about something like a $3 trillion deficit we're going to be running, although it comes down to all the way down to $1.2 trillion in the out years. What do you make of the CBO report on the economy?
Look, I think it's saying something that is the conventional wisdom that might be right, but I don't think we can count on it being right. You know, that CBO report assumes no passage of the Biden plan. It assumes no extensions of a range of tax cuts. It includes not much in the way of emergencies. So it's probably a substantial underestimate of where the deficit is going to turn out to be. And it's saying that we're going to be a country basically for a decade where the real interest rate's going to be negative, where the budget deficit's going to be close to 5% of GDP, and where the debt ratio's going to be above 100%. And that's all going to be sustainable. It might turn out to be right, but for it to turn out to be right, it's going to require that there be a very substantial excess of saving over investment, or it's going to require that we be borrowing very substantially from abroad. In many ways, it's a bet on, ironic for me to say this, it's a bet on secular stagnation.
So Lauren, just pick up on one thing that you just said there, negative real rates going out into the future indefinitely. Doesn't that have to be wrong? Or if it's right, doesn't that tell us that something's gone terribly wrong with the economy? That can't be healthy.
Well, I think what it's telling you is that there's a lot of desire, a lot of uncertainty. People are going to live a long time, that you've got very substantial desires to save and limited desires for resources for investment. I think it is substantially concerning, David, if it turns out to be right. But remember that some of it is being driven by what's basically a very positive thing, which is that capital goods are getting cheaper. My $600 phone can do more computation than a $25 million supercomputer could in the 1990s. That's progress. That's something that's good, but it does have this consequence that we have this excess of saving, and that's something we have to manage. Now, this forecast is assuming that that excess of saving is really big, because we got room for all of these deficits without all this debt, without pushing up interest rates. If that's right, then we're doing the right thing and it will all work out. That was the secular stagnation view. It's just this is kind of secular stagnation on steroids, given how low the real interest rates are going to be in the forecast and how big the deficits are going to be.
So, Larry, this week we saw the end of the first half of 2021, and for investors, it was a pretty good one by and large. I mean, the S&P 500 was up 15%. We had the 10-year rate going from just under 1.0 up to 1.5, but still staying fairly contained. And oil went up from like $49 to $75. What should investors be looking at in the second half? And maybe more important, what do you think they might be missing?
Look, I think they are looking at inflation. They should be looking at inflation. It's no secret to your listeners that I think that the conventional wisdom is behind the curve on inflation, and nothing I see in the data flow has changed my mind about that. It's actually probably reinforced my convictions. But there's a broader phenomenon, David, which I like to call the throw in the towel theory. The most dangerous moments in markets are when people are worried they're too high. They lighten their positions, they sell short in some cases, and then the market keeps going up, and they throw in the towel. And then other people decide it's too high, and they lose money, and they throw in the towel. And so it's precisely when all the pessimism has been beaten out of the system that markets are most vulnerable. That's why if you looked at probably the biggest bubble ever, what happened in Japan in the 1980s, there were more bears at 25,000 than there were at 30,000, and many more at 30,000 than there were at 35,000, and the eventual collapse came at 39,000. I see that as a concern right now with our markets, and so I'm worried that people have learned exactly the wrong lesson from the phenomenal six-fold increase in market levels since 2008. I think they've learned the lesson that trees grow to the sky, and I think I've learned the lesson that trees are too tall to be stable. And that makes me nervous. I don't know what the horizon is, and people make huge mistakes by getting out of markets too early. So I'm not giving market timing advice, but I do think that so many failures for pessimism, ironically, can be a basis for even bigger pessimism.
Okay, Larry, let's wrap it up, as we always do, with a rapid round of Summer Says. Let's start first with somebody you knew, Donald Rumsfeld. Served twice as Secretary of Defense. And I think, although he was controversial sometimes, some people might even suggest you sometimes have been controversial, I think everybody agrees he was very intelligent, and he also was devoted to his country. What did you know of Donald Rumsfeld?
He was always a good friend to me. We didn't know each other well. Obviously, on questions like the Iraq War, we had some major disagreements, but I learned from him. His observations about unknown unknowns are, I think, something anybody in a leadership position has to pay a lot of attention to. And one of the shrewdest bits of management advice I've ever received was his famous statement that A's hire A's and B's hire C's. And I think every manager in America should keep that in mind as they make hiring decisions for organizations for which they have responsibility.
That really is terribly good advice. I agree with that. Second subject here is Facebook. Facebook won in its motion to dismiss against the FTC. They had to pull back the case. They may file again. How significant was this development?
I think it said something very important for the antitrust debate. Whatever you think, and the people who are very worried and others who are less alarmed about the big tech companies, if one wanted to mount a major attack on what they're doing, we probably need not just more aggressive enforcers, but changes in the antitrust law. And that's a basic reality that everybody needs to consider, whatever their opinion on what's desirable is. It's something that investors, as they handicap the antitrust possibilities, need to recognize as well.
And finally, third subject, housing prices. They came out this week, and the Case-Shiller was up the most it's been up in 30 years. We got something of a housing boom, if not a bubble. What do you make of that?
I think this is scary. I think rising house prices, in most people's common sense of the word, represent inflation, whatever exactly is showing up in some price index. My guess is that the increases we've seen are going to find their way into the price indices over the next year, even if we don't see further increases. My guess is we are going to see further increases in house prices given continuing shortages. And my guess and my judgment is that if that doesn't get reflected in the indices, it tells you something about the indices, not about the economy, and that this is surely a major indicator of substantial inflation psychology and needs to be taken very, very seriously. I cannot understand why the Federal Reserve, in the face of this, continues to be every month a major buyer of mortgage-backed securities. That is the ultimate in pro-cyclical behavior.